Our session is on valuing stocks and bonds. Here we apply financial math to some key problems in finance, namely the determination of bond and stock prices. Obviously, this material will be useful as you work to increase your personal wealth positions. We cover 6 topics: bond valuation using annuities, the process of common stock trading, stock valuation in a conceptual sense, estimating the cost of equity capital, stock valuation using perpetuities, and some stock valuation terminology. First, we cover bond valuation, which is more straightforward than stock valuation. Several parameters determine the value or price of a bond. The first is face value. The bond is a piece of paper that the borrowing company will sell to a lending individual or agency in exchange for cash. On that piece of paper will be a stated face value, which indicates the amount of cash that the lender or bond buyer receives when the bond matures. The second parameter of bonds is the coupon rate. It's the stated rate of interest that the borrower pays the lender. The coupon rate will also be indicated on the face of the bond. In our example, the coupon rate is 5%. The third parameter is the frequency of payment of interest. To use the symbol that we had in the last session, frequency of payment is going to be designated by M. And in the example that we're going to go through, we have annual payment of interest so that M is equal to 1. The fourth parameter is the actual interest payment received in each time period. It's fully determined by the 3 parameters that went before it. So if we have a face value of $1,000 and a coupon rate of 5% and annual payment of interest, the bondholder or lender will receive $50 per year in interest payment. The fifth parameter is maturity date, or the number of years that the bond is outstanding before it matures. Maturity date indicates how long the lender or bondholder has to wait to receive the face value back. It also indicates the number of years that the lender or bondholder will be receiving the interest payment. The sixth parameter is yield to maturity. Yield to maturity indicates the actual rate of interest that any particular bondholder will earn on the bond. It's determined by prevailing interest rates in the market as well as the relative riskiness of the borrowing company. The final parameter of bonds is the price of the bond, which is the one we're after. The price of the bond is determined by a present value calculation. So the market price of the bond is given by the following equation or expression. Price of bond is equal to the sum from year 1 to the term of the bond of the interest payments appropriately discounted plus the face value of the bond appropriately discounted depending upon the term of the bond. That is to say, a bond holder gets to receive a series of interest payments and a return of principal. Now, the series of interest payments can be conceived as an annuity, in this case, a 5-year annuity of $50 per year, plus a one-time payment of principal. Let's go through a bond valuation example. Let's say the data on the previous slide refer to 10-year bonds originally sold to the public by Dandy Crowing Company in 2002. Dandy Crowing Company is the borrower. The public, that is people like you and me, are the lenders. So Dandy sells the bonds or pieces of paper to us, and we get the right to receive interest and a return of principal 10 years later. At the time of the sale, prevailing interest rates on the debt of firms such as Dandy, that is, on the debt of firms with a risk level of Dandy's, were 5%. So let's say it's now 2007 and interest rates have risen to 6% on the debt. Now let's further say that the original bond buyers or lenders are interested in selling their bonds in the public bond markets or secondary, let's say secondary bond markets, in order to get some money back. So they're interested in selling the bonds in the public bond market. The question is, what is the 2007 price of Dandy's bonds? Okay, we've scooted over to our Excel file again. And I've got a spreadsheet that I've labeled bond valuation. Here are the parameters in our example. The face value or future value of the bonds is $1,000. The term that's remaining on the bonds is 5 years. This number deserves a little bit of explanation. I said the original bond term was 10 years. The bonds were sold in the year 2002. It's now 2007. Hence, the bonds mature 5 years from now, or in 2012. And we're trying to determine at what price the bonds will sell in the bond market right now. We know that the coupon rate on the bonds is 5%. That's the stated rate of interest on the face of the bonds. And further, we're told that between 2002 and 2007, prevailing interest rates in the market have risen from 5% to 6%. Let's say that that increase in prevailing interest rates was maybe caused by actions of the Federal Reserve Board to tighten money, to raise interest, etc. So we have an increase in prevailing interest rates, and we want to find out what happens to the price of a bond in a situation where interest rates have risen. So we want to calculate the present value of the stream of cash flows that you get if you buy the bond. We set up our typical cash flow analysis structure, where we have a column that indicates the year end that we're interested in, and we have years going from 0 to 5 in this case because the term of the bond is 5 years, and we have a column indicating the cash flow associated with holding the bonds. And we know that the bondholder gets $50 per year in interest payment for years 1, 2, 3, 4, and 5. And then at the end of year 5, the bondholder also gets the $1,000 return of principal. So somebody who buys the bonds gets to receive this stream of cash flows. Now determine the bond buyer's, the new bond buyer's willingness to buy these bonds. We need to determine the price of the bonds in the market. What is the value of the bonds to bondholders now? Okay, as you can see, once again, I've calculated the price of the bonds using the NPV function. It's going to be $958. Let me delete that and show you the calculation. So once again, we go to the function wizard, find the NPV function. That's the one we want. The rate that we want to indicate here is the discount rate that the bond buyer or the bond buying market is going to apply to the cash flows associated with owning the bond. And that's going to be prevailing interest rates on bonds of similar risk. So I'm going to highlight the cell that has the 6% R, or discount rate, or market capitalization rate. The second argument in the NPV function is the stream of cash flows. So I'm going to highlight the cells from years 1 through 5 to indicate the cash flows associated with holding the bond to maturity. Say OK, and we can see we get $958. Now let's talk about the interpretation of this present value calculation. One interpretation is that the bond buying public is going to be willing to pay $958 in the year 2007 to receive a stream of cash flows that is represented by this column for the next 5 years. Another interpretation is the bond buyers are indifferent between getting $958 now and this stream of cash flows for the next 5 years. A third kind of important interpretation is that bond buyers who purchase these bonds from Dandy Crowing Company for $958 receive $50 per year in interest payments for the next 5 years, and $1,000 at the end of 5 years, will effectively earn 6% on their money. A final interpretation is that the original bond buyers bought the bonds for $1,000 and are turning around 5 years later and are selling the bonds for $958. Hence, the original bond buyers are suffering a capital loss on their bond sale. A final interpretation, and a really key one, is that bond prices fall as interest rates rise. So if the Federal Reserve Board goes out in the market and does whatever it does to raise interest rates, lenders, that is bond buyers, will see a reduction in the price of the bonds that they hold. To finish up this example, let's see what would happen to the price of bonds if interest rates had fallen instead of rising in the period 2002 to 2007. On this part of the spreadsheet, I've reproduced the cash flow stream associated with holding the bonds for 5 years. The only thing that's changed is the discount rate. So the discount rate has gone down from 5%, the original coupon rate at the time the bonds were issued, to 4% in the current period 2007. And you can see what has happened to the price of the bonds is that they've risen from the original face value price of $1,000 to a new market price of $1,045. Okay, again, a couple of interpretations might help here. One is that the original bondholders purchased the bonds at $1,000 and 5 years later can sell them at $1,045. So the original bondholders enjoy a capital gain on the sale of their bonds. Second interpretation is that the new bond buyers in 2007 will pay $1,045 for the bonds. They'll receive this stream of cash flows for the next 5 years, and in so doing will earn an effective rate of interest on their investment of 4%, which is the appropriate rate given what's happened to prevailing interest rates in the market. And finally, a third interpretation is kind of the general relationship, which is bond prices rise as interest rates fall. So just to see that again, bond prices will fall if interest rates rise, and bond prices will rise if interest rates fall. Okay, let's move from bonds to stocks. And first clarify some terminology associated with common stock trading. The first one is common stock, which just represents ownership shares in a publicly traded corporation. Shares are traded in secondary markets, or markets in which already issued securities are traded among investors. Secondary markets are distinguished from primary markets, where bonds that are initially issued are sold. So when, let's say, Dandy Crowing Company wants to raise equity capital, it will sell stock, buy it from itself to the stock buying public in a public offering in primary stock markets. Then the owners of Dandy Crowing Company stock would be able to trade that stock or sell that stock to somebody else in the secondary market. Third term is a dividend, which is a periodic cash distribution from the firm to the shareholders. A dividend payment in cash flow terms is analogous to an interest payment to a bondholder. The price-earnings ratio is the price per share divided by the earnings per share. The book value of the firm is the value of the firm according to the balance sheet. That is the numbers that you read on the balance sheet that say the asset value is $10 million, the equity value is $4 million, the debt value is $6 million. That's the book value. The liquidation value of a firm is the net proceeds that would be realized by selling the firm's assets and paying off its creditors. So, in a sense, that's the residual equity value. The assets have a market value that can be realized by selling its assets. Then the proceeds of that sale would go first to paying off the creditors, and then whatever is left over is the liquidation value that's available to the shareholders or owners of the firm. Finally, market value is the value of the firm in the financial markets as a going concern. Market value is determined by the stock price times the number of shares outstanding. Now let's move to stock valuation, which, as I said earlier, is not so straightforward as bond valuation. There are parameters that determine the market price of a stock, but these are really parameters that are concepts more than hard and fast numbers that we saw in bond valuation. So parameter 1 is the current price of the stock, which is what we want to determine. Second parameter is the future price of the stock. And of course, if we knew the future price of the stock, we would be infinitely wealthy. The third parameter is the future stream of dividends that the owners would receive if they held shares of stock. And the fourth parameter is the market capitalization rate, or the rate of return that investors in the firm's stock expect to receive by owning shares of the stock. Let's talk more about this market capitalization rate idea. To get into it, we need to define or think about another related concept, which is the cost of equity capital. The firm goes into the equity markets to raise equity capital, and that equity capital has a cost. And the cost is actually determined by the rate of return that potential investors or stockholders impose on the firm to justify their putting money into the firm. So let's start with the notion of expected return, which is the percentage yield that an investor forecasts from a specific investment in a stock over a period of time. And that expected return is called the market capitalization rate. The expected return, or market capitalization rate, that an investor wants to earn on a share of stock depends on the relationship between the returns on the stock and the current stock price. So let's take a situation where an investor purchases a share of stock at the beginning of the year for P sub 0. The investor holds the stock for a year and at the end of the year sells the stock for P sub 1. The returns to the investor associated with holding that stock are of two types. One is a dividend payment that the investor gets if the firm decides to pay dividends. And the second is a capital gain that the investor enjoys if the stock price has gone up. Now, the capital gain is the second piece of the numerator here. I'm going to just put brackets around it. The difference between P sub 1 and P sub 0 is a capital gain that the investor would earn if the stock price has risen. So the investor gets two things by buying and holding and then selling a share of stock for a year. One is a dividend payment and the other is the capital gain. If we divide those two return amounts by the original purchase price, we get the expected return, or the market capitalization rate, or let's say the required rate of return that the investor expects or wants to earn in purchasing the stock. Let's look at an example of the determination of the cost of equity capital. Let's say we have a firm, Red Hen Feathers, whose stock is selling for $100 per share today. And let's say that the market expects that the stock price is going to be rising to $110 at the end of the year, or 1 year from now. The question is, what is the expected return if the dividend in 1 year is forecasted to be $5? Using our expression from the previous slide, we have in the numerator the $5 dividend payment, the capital gain associated with the stock price increase, and in the denominator we have the current stock price. If all of these events pertain, then what we have is an expected return on Red Hen Feathers stock of 15%. The cost of equity capital discussed in the previous few slides is the key determinant of stock price. This slide uses a dividend discount model to determine stock price depending on the cost of equity capital. Essentially, the price of a share of stock today depends on the present value of all future dividends. Here's an expression, a present value equation for the price today as determined by a future stream of dividends discounted appropriately. And we'll have R as the cost of equity capital, or the market capitalization rate. And so what you see is that the price now, or time zero, depends on the dividends every year discounted appropriately out to an evaluation horizon, plus the price at that evaluation horizon. So you can almost think of this as, or you can think of this as analogous to the bond valuation formula, where in the bond valuation formula we had the interest payment in year one discounted by 1 plus R to the 1 power, plus the interest payment in year two appropriately discounted, all the way out to the interest in year 5 appropriately discounted, plus the return of principal. The return of principal is analogous to a stock price at the planning horizon, or at the stock valuation horizon. Here's an example of stock price determination using the dividend discount model. Current forecasts are for Wahoo Company to pay dividends of $3, $3.24, and $3.50 over the next 3 years, respectively. At the end of 3 years, the market, or you, anticipates selling the stock at a market price of $94.48. So using this model, what is the price of the stock if your market capitalization rate is 12%, or your expected return is 12%? The present value, using the expression from the previous page, the present value or stock price is equal to $3 dividend in year 1 divided by 1.12 to the 1 power, plus $3.24 in year 2, again appropriately discounted, plus $3.50, plus the expected stock price in year 3 divided by 1.12 cubed. And that comes to $75.36. We're back to our Excel file, and I just want to show you how the future dividend valuation model We're back to our Excel file, and I just want to show you how the dividend discount model would be calculated using the NPV function in Excel. Here are our parameters: a market capitalization rate of 12%, a term of the investment of 3 years. The cash flows are going to be looked at over years 0, 1, 2, and 3. The dividend payment in year 1 is $3. The dividend payment in year 2 is $3.24. In year 3, the shareholder gets the dividend payment of $3.50 up here, plus expects to be able to sell the stock for $94.98. And the NPV calculation, this time I'll just kind of show you. It's invoking the NPV function. The rate is the 12% here in B2, and the cash flows are in these cells for years 1 through 3. And this stream of cash flows gives us a current market price for the Wahoo stock of $75.36. Very importantly, what this means is that if the market puts a capitalization rate of 12% on Wahoo stock, and then has this stream of expected dividend payments and expected stock price in year 3 of $94.98, then the market would be willing to pay, right now, $75.36 for a share of Wahoo stock. Obviously, stock price determination depends on projections of a lot of values that are unknown at the time that the stock price is set. In particular, the stock price valuation depends on projecting future dividend stream, which is hard enough in itself, but also even more difficult, it depends on projecting future stock price. Because of the difficulty of projecting future dividends and future stock price that are required in the dividend discount model, many stock investors rely on versions of a perpetuity model to help them understand and predict stock price movements. According to the perpetuity model, as applied to a no-growth firm, today's price depends on current and future perpetual dividends. Recall from the last session we looked at the present value of a perpetuity, and I said we would use that concept as a way to think about stock valuation. Here's a version of a perpetuity formula where we think of the present value as the current stock price being determined by the dividend that's paid today, which is assumed to be the same as the dividend out for the foreseeable future, divided by the market capitalization rate. Let's apply this formula to an example. What is the price of a share of no growth stock that currently pays and is expected to pay in perpetuity a dividend of $12 per share if the market capitalization rate is 6%? We're back to our Excel file, and I've labeled a part of this spreadsheet stable stock valuation. The parameters are, we have a market capitalization rate of 6%. We have a no growth firm, so the rate of growth is 0. I'll come back to that concept in a bit. And the perpetual dividend is $12 per share. In this very simple example, the price of a share of stock in a no growth firm is simply the ratio of the current dividend, or future or perpetual dividend, I should say, to the market capitalization rate. So the price of this stock should be $200. Now let's apply the perpetuity model to a growth stock. Again, recall that the present value of a perpetuity, of a growing perpetuity, is the cash flow or perpetual cash flow divided by R minus G. In the case of stock price valuation, again, the price is a present value calculation. The current dividend is in the numerator, and in the denominator is the market capitalization rate minus the expected growth in the earnings of the firm. Let's apply this growing perpetuity model in an example. The question is, what is the price of a share of stock that currently pays $12 per share in dividends and is assumed to grow at 3% per year if the market capitalization rate is 6%? And what will happen to share price if the growth rate falls to 2%? We're back to our Excel file, and just to review, our stable stock situation had a market capitalization rate of 6%, an assumed growth rate of 0, and a current dividend of $12 per share. Now we're moving to the growth stock situation where we have a current dividend of $12 per share, same market capitalization rate, but the growth rate is now assumed to be 3%, or the assumption is that this firm is going to be growing at 3% per year. Applying our value, our present value of a growing perpetuity formula, just kind of highlight, we get a stock price that's determined by taking the current dividend and dividing it by R minus G. So if we have a growing firm that has the same current dividend, we have a much higher stock price. Kind of the important lesson here is that stock price is highly sensitive to what is expected about the growth possibilities of the firm. Now, just to kind of reinforce that point, let's see what happens to our determined price if for some reason the market wakes up in the morning and says, oh, you know, this firm is not really expected to grow at 3% anymore. It's expected to grow only at 2%. I'm simply going to change the G in our growing perpetuity formula from 3% to 2%. And you can see the stock price falls precipitously from $400 per share to $300 per share. Again, I want to reinforce how sensitive the price of a share of stock is to what is assumed about the growth opportunities of the firm. Now just take this learning point and think about what it means for how you ought to be thinking about your own personal investments. Who knows most about the growth potential of a firm? Do you know as much as the market? Does the market know as much as the insiders? An awful lot about the rules and regulations of insider trading have to do with this G, with who knows what about the growth rate of the firm. Because you can look at the current dividend, you can look at essentially the market capitalization rate, which is the rate of return that the market wants to earn on firms of a particular risk level. These two numbers are pretty well known to the market and to the world generally. However, the growth rate that's expected for a firm is something that is not well known by the market in general unless the firm shares that information publicly. Now, typically firms do share that information publicly, but the whole point is there are different levels of information or degrees of information about the growth rate, expected growth rate in a firm. And those people who do well in the stock market are those that have the best estimates of the future growth potential of firms. Okay, just some additional terminology before we conclude this session. There are some common measures of returns on investment or returns on stock ownership that we haven't yet covered. I think actually we did cover the concept of dividend yield, which is the current dividend rate divided by the current stock price. We haven't covered the general concept of return on equity, which in an accounting sense is defined as earnings per share divided by book equity per share. Book equity per share comes from the balance sheet of the firm, and it essentially is the value of the equity as stated in the balance sheet. Some more terminology. Note that if a firm elects to pay a lower dividend than it could and to reinvest some of the cash flow associated with operations in the firm at a relatively high rate, the stock price will increase because future dividends may be higher than they are currently. The whole notion of whether a firm should retain and reinvest earnings versus paying the earnings out as dividends depends largely on the relationship between the return that the shareholders could earn on alternative investments in other firms and the returns that the firm in question could earn by reinvesting in new business opportunities. The concept of payout ratio is the fraction of earnings paid out as dividends. And the complement of the payback ratio is the plowback ratio, which is the fraction of earnings that are retained by the firm and reinvested. Obviously, the payback ratio and the plowback ratio add to 1. Just a couple of other terms. One is the present value of growth opportunities. We haven't really talked exactly about net present value yet, but the notion is that the firm has future investments that it can engage in, and those investments can return value to the firm. And the present value of those future investments is often called the present value of growth opportunities. Firms that are growing firms are those that have significant growth opportunities that can add value to the firm. We're going to be discussing growth opportunities and net present value calculations for firms in a subsequent session. And finally, the notion of sustainable growth rate is the rate at which a firm can grow kind of in a steady sense if it takes its some of the earnings that it plows back into the firm and can reinvest those at its current return on equity.